Hey everybody, Smart Silver Stacker here. Welcome to another live stream. So, fairly big day for the price of silver, but not in the green variety of move. No, it is a smackdown today. Price of silver at the time we're doing this live stream down over $1, about 3.44%. But it's not just silver. As you can see over here, markets across the board, all the major stock indexes in the red. If we look at commodities, all the commodities are down today. Crude oil, gold, natural gas, other metals, platinum's in the red today as well. But silver is having kind of a disproportionate move. And days like today, if you're sitting on physical metal, it's a nice thing about stacking physical, right? If you're managing things responsibly, you're not using leverage, you're not trying to time things, then you more or less can just sit through these things and not worry about them too much. Now, I will say it may be a buying opportunity for some of those who have been waiting for a pullback, but I want to talk about that and, how far of a pullback we may get here as we see all the commodities sell off. And if this invalidates the breakout in commodities, the rally in commodities that we have been watching play out over the past several weeks. So, first of all, today's video sponsor, ST Bullion. If you do want to buy the dip here today under $30, my top picks would be Valcambi silver bars. They have 99 cents over spot, or junk silver, which premiums on this are still dirt cheap. And I see some folks in the chat there asking, what is going to happen to silver? Will it go back to $25 an ounce? Well, let's take a look at the chart, and I will give you my best forecast. Now, I was expecting silver to hold the $30 support. However, I also mentioned in a recent live stream that the chart was starting to look a little bit uglier. We have this kind of double top here. It's a little bit ominous, and it looks like now that $30 support has broken, it's very possible we may see some additional weakness. Now, it's still only before noon right now. It's 11:46, so I guess there's a possibility that we could see a rally in the commodities before close. But if we don't, if silver closes below $30, it's looking like that's a possibility. You could see some further weakness here moving forward. But in light of that potential weakness, let's talk about how far silver could fall, first of all, and then we'll look at some historical incidents and see what this might mean for more of like a medium-term forecast. But I want to draw your attention to this line here, just under $26. You can see that this was resistance for a long time. We touched it 1, 2, 3, 4, 5 times until we finally broke out from this consolidation pattern in silver recently, back in April. And so, that's sort of the new support line, I think, that we can look at. It's very unlikely silver will breach that level of support. If it does, then that may mean, I don't know what's going on. The commodity rally could be over. We could be seeing some kind of a deflationary recession in the works. But that seems unlikely to me. However, we could see a trip back down to the $26 level. If we do, look, not financial advice, but I'm going to say that that's kind of back up the truck territory if we get that chance again. And let me show you why I say that. First of all, let me get rid of this support line here. You can see silver broke out of this long consolidation pattern here back in April, and we followed that pretty closely. This is a very bullish formation, this symmetrical triangle here. The breakout here should set us into the 40s, right? So I think that breakout is still certainly in effect, despite the fact that we've gone below $30 here. It's just that we might see a little short-term weakness. But let's look at the 2011 breakout. Let me get rid of this line. So this is 2011 when silver went from, in 2010, around $18 here, all the way up to $50 in a fairly short period of time. And you notice that this is the $30 level, which we recently broke above. Now we're just slightly below. Silver on its way up to $50, it actually broke through $30 once, twice, then it retraced slightly down to about the $26 level, and then it rallied off of that. And in a matter of, if we go to the weekly chart here, you can see that it was really just a matter of a few weeks, about 10 weeks, to get from 30 to 50. So it's very possible that we could see a retracement and then a stunning rally. And I think that that is certainly something that is possible. It's kind of like what we saw in gold. Let me see if I can get the gold chart up here. All right, so in gold, you recall we had this line, which is around 2080, and we touched that in 2020, touched it again in 2022, touched it again here in 2023. Keep trying to break through that 2080 line, but it was resistance for a long time. Then we got a breakout. You remember this occurred on a Sunday night back in December of last year. We had this big breakout above it, but turns out it was a false breakout. Then we had consolidation, and then the big run up to new record all-time highs. And, you could see something very similar to that in silver. Nothing goes up in a straight line. You got to understand that. And silver is a volatile asset of all assets. It's one of the more volatile commodities out there. So, you can't expect this rally to just go straight up. And silver has gone so sharply up from February, when it was around $23, to a peak of 32 just a couple weeks ago, that it's certainly not unusual for silver to sell off a bit, take a break, consolidate before it resumes this breakout higher. Now let's talk about what's causing the specific weakness today. It seems to me that crude oil is kind of leading the pack here on this sell-off in commodities. You can see this sell-off has been going on for several days now, and it's pretty sharp. I mean, silver's back, or crude oil rather, back down to $73. And why is that? Well, there's concern, I think, about weakening economic growth in the global economy. And in the U.S., we saw that last week with GDP numbers. They grew at 1.3% in Q1. That was less than expected. It was a result largely of a weak consumer. And we know, the economy is terrible. It's not, it's an economy where you have a bunch of people working part-time jobs, maxing out their credit cards, taking on all sorts of levels of debt. Homelessness is on the rise. Poverty is on the rise. So the concern that economic growth slowing could lead to lower commodity prices because of lower demand, I think, is valid. However, when you look at the balance of things, weakening economy in the U.S., it also means that the Federal Reserve is more likely to cut rates and return to stimulative monetary policy. And no amount of economic slowdown can stave off the inflation that will cause, right? We still got the U.S. national debt, $34.8 almost trillion, a $2 trillion annual deficit. And, think about this. The deficit is incredibly inflationary at these levels because what's happening? I mean, rates have been raised and deficit spending has increased despite that. So that means that the government is borrowing a huge amount of money and then they're paying a huge amount of interest out on that debt. Where is that going? Well, it's going into people's money markets accounts. The debt holders are getting paid this vast sum of interest. The interest payments on the national debt now over $1 trillion. So this is all really very, very inflationary in the long run. And there's a ton of dollars out there that are going to be chasing a very scant amount of gold and silver in the near future. Why do I say that? Well, take a look at this story recently broke that there's $517 billion in unrealized losses in the U.S. banking system. That's according to the FDIC, who now says that 63 lenders are on the brink of insolvency. This was the report for the FDIC for Q1, say that the unrealized losses on available for sale and held to maturity securities increased by $39 billion to $517 billion in the first quarter of this year. Higher unrealized losses on residential mortgage-backed securities resulting from higher mortgage rates in the first quarter drove the overall increase. This is the 9th straight quarter of unusually high unrealized losses since the Federal Reserve began to raise interest rates in the first quarter of 2022. So think about this. This is due to rising mortgage rates. As mortgages, the rate on them rises, the existing mortgages that the banks hold that were taken out when rates were much lower, they go down in value. It's just like with treasuries. Like what we saw, what kicked off the regional banking crisis last year was the banks were sitting on these U.S. treasuries, which had devalued because they're low yielding. Well, the same problem with residential mortgages. Now, They will paint this as not being a problem because they can just hold these securities to maturity. But again, what if a bank needs to sell some of these to raise capital when depositors withdraw cash? The whole system is very levered up. There's a lot of unrealized losses, both from treasuries, from mortgages, all of these things that these banks are sitting on. And ultimately, this means the Federal Reserve is going to need to print. Why? Well, this is what the FDIC says. These issues could cause credit quality, earnings, and liquidity challenges for the banking industry. In addition, deterioration in certain loan portfolios, particularly office properties and credit card loans, continues to warrant monitoring. Yeah, you've got a weak consumer out there, the weak consumer contributing to lower economic growth in Q1. Remember, those consumers are sitting on over $1 trillion in credit card debt. When they start to default, that means the banks are going to come under pressure because they are the ones holding that debt. They're going to have to absorb those losses. Commercial real estate properties plummeting in value. They've been kicking the can down the road on that, trying not to renew loans. That's why there's close to $1 trillion of loans in 2024, which is going to be up for renewal, and that means they're going to reach maturity. These properties, unfortunately, they're not worth what they were when those initial loans were created, when those mortgages were taken out. So again, a huge source of losses. All of this can only be fixed by either absorbing a massive default and, likely witnessing the failure of many banks, or alternatively, we know that's not going to happen, right? So what are they going to have to do? They're going to have to paper over everything. They're going to have to slash interest rates. They're going to have to drive the rates of mortgages lower, bring buyers into the market, and also to eliminate those unrealized losses. Now, on what timetable will that occur? I'm not trying to time markets here, but clearly when you see a pullback in the price of hard assets on a day like today, and this is the backdrop, that's why I say it's a buying opportunity. What else do we have? Okay, central bank net buying rebounds in April. This is referring to central bank purchases of gold. According to the IMF and the World Gold Council, you can see here the furthest right, that's net purchases have increased. They had kind of flattened out here, the sales and purchases by central banks in March, but now once again they are buying more than they are selling. And you look at this chart, it goes back to January of 2022. There's only 1, 2, 3 months when central banks were net sellers of gold. So that tells you something. I mean, you can say that maybe the central banks are wrong, but since they're the ones who control the printing presses and decide whether all the debt gets monetized and what happens to the fiat currencies, I would say that they're probably the smart money in this situation. And where gold goes, silver goes. We're seeing that today. Gold's pulling back, maybe not as much as silver, but that is just the nature of the metal. Silver's a much more volatile market. China, of course, adding huge amounts of solar capacity. Why does this matter? And this is an article from January from Bloomberg. China added more solar power in 2023 than the U.S. has ever built. You see here that in 2023, they added 216.9 gigawatts of capacity. That's more than the U.S. in total, more than India in total, more than any of these other countries in total. China has a huge demand for silver and copper because of this expansion. And we're seeing that in the Shanghai Gold Exchange. So this is the Shanghai Silver Benchmark price chart from the Shanghai Gold Exchange. And if we scroll down, we can see that they've seen a bit of a correction in the price of silver as well. Yesterday, the price dropped as low as 7,873 yuan per kilo. Now, if we do a little bit of math, that comes out to $1,086.91. And then if we pull up our calculator, we can figure out the troy ounce price in dollars, just to divide that by 32.15. So silver dropped as low as 33.80 on the Shanghai Gold Exchange yesterday, but it's already rallied back up to over $34. You see 8,061. That's the most recent price. So a little bit of a pullback on this Chinese exchange as well, but they're bidding up the price of physical. That's why there's this huge premium in those markets. So look, I mean, pullbacks today in physical commodities. You've got copper on sale, silver on sale, gold's on sale, crude oil is on sale. All of these things, in my opinion, my forecast, medium term, even short term, headed much higher, right? I mean, we might see a bit of a pullback here to silver, maybe to the $26 level. That would be like the extreme case. If that happens, again, I'll be backing up the truck. I bought some junk silver over the weekend. It was on sale at SD Bullion. I think I paid like $240 per roll or something like that instead of $223. Could I have saved some money by buying today? Yes. Am I upset that I stacked at a slightly higher price? Not really. I mean, I'm more excited that I swapped some more fiat for some more physical assets. And if you waited until today, congratulations. But you got to understand that, you look at this chart for silver, this is a very bullish looking chart. This is a breakout from, a year's long consolidation. In fact, if you draw this line from the previous 2011 high to kind of encompass these highs here, you see that we've broken out of a very important downtrend here. The breakout is intact, right? Same story goes in gold. Gold has got this cup and handle formation, which was building since 2011. You're not going to invalidate that breakout by a drop of a couple bucks in the price of gold. So gold and silver both heading much higher from here. Any drops from this point on will be buying opportunities. How low could it go? 26 bucks, probably about the worst. As long as you're not using leverage, you're managing things responsibly, you're not trying to time markets too much, I think we'll all be fine as stackers. But let me know what you think in the chat down below. See a lot of people in the chat saying they love cheap silver. Me too. Definitely a good time to be stacking, I think, because ultimately these things are going to be lifeboats for the mess that is on its way. Nothing has changed fundamentally. It's just that markets are putting silver on sale today. So again, let me know what you think in the comments down below. Okay, I've seen a few questions in the chat. Someone says, will you explain how the premium is applied to silver? Well, if you go back on the channel, I've got several videos where I explain this and other things. I mean, this is kind of a basic question, but yeah, the premium, if it's 99 cents over spot, and if the spot price is, 29.53 or whatever, it should be 30.53. Now, you will see sometimes some dealers will use, instead of, say, the spot June contract, you might also see the July contract traded. So you'll see some slight variations in the spot price. That's because very likely this silver July contract is a higher volume contract at the COMEX. So that's what will be quoted as spot in some places like here on Yahoo Finance. But typically, yeah, you're going to take some variant of the spot price. And you got to understand, spot price is just the price of a futures contract. There's one for each month. So sometimes they'll take the current month, sometimes they'll take the most actively traded months, but it's just a paper contract, but they take that and then add the premium to it. So in the simplest summation, yeah, that's what a premium is. And one thing that we have seen, for those of you who are relatively new to silver, is right now, this is a fairly low premium for 90% US silver coins. Back in March of 2023, when the bank started to fail, there was this huge rush into physical assets, and you didn't see the spot price move too much, but coins like junk silver coins, if you could find them anywhere, the premiums exploded because it wasn't that people wanted futures contracts, they wanted real tangible assets. And when the next crisis plays out, which is, inevitable because of things like this, $517 billion in unrealized losses on the U.S. banking system, $34.7 trillion in debt, unfunded liabilities of $216 trillion. I mean, there's a crisis coming, right? We just don't know when exactly or what the catalyst will be. But when that happens, $223 for a roll of junk silver coins, you'll look back on that and you'll think, wow, that was really, really cheap. That's just my take on it. But anyway, let me know what you think in the comments down below. Stay safe and happy stacking, everybody. I'll catch you next time. Smart Silver.